So what we did last week, we discussed the project evaluation technique, right? So there were a few only last week. So we discussed how to evaluate a project, what are the areas to be evaluated, like market, technical, financial, economical, legal, like that. We discussed the areas of feasibility. Then we came to investment appraisal. There we discussed break-even analysis, and then we discussed accounting rate of return. Like if I recap a little bit, break-even analysis is this, right? You have fixed cost. This is the fixed cost. Then we have variable cost. Variable cost, which is the, then this is the total cost. That means this one plus this one together, it is total cost, right? Then we have revenue, total revenue line, total revenue, right? So if we write like this, I got it here. Turnover equals variable cost plus fixed cost plus profit, right? This is our business formula. So turnover equals price into quantity. Variable cost equals Q into variable cost per unit, right? Fixed cost is fixed cost. On a break-even point, this one profit will be 0. Break-even point is the point at which no profit, no loss situation occurs. See, at this point, this one, total cost equals total revenue. So if you drop like this is your break-even quantity. This is your break-even sales, right? So that is the break-even. So it is the point at which no profit, no loss situation occurs, right? Then break-even quantity equals fixed cost minus price minus variable cost per unit, right? This is called, this one is called contribution. What is the amount of money we will be contributing towards the recovery of fixed cost per item? This is break-even quantity formula, right? Then whenever you get a question saying that we need to create a profit of 10,000, so here you add profit component also, right, in this calculation. Then we discuss a point called margin of safety. That is the difference between actual or projected sales and the break-even sales. If this is the break-even sales, if your actual sales is something like this, the difference, this one, this is the margin of safety. So if the budgeted sale is this, the difference between break-even sales, this one and this point. This part is margin of safety, that is break-even point. Then we went on to discuss accounting rate of return, which is equal to average profit divided by average investment, right? Average profit, if we have a 5-year project life, P2, P3, like that, P5 divided by 5. This is average profit. Average investment, initial investment plus residual value divided by 2. So this is the accounting rate of return. Average profit divided by average investment. Average profit is for the lifespan, you add all the profits and divided by the number of years. Average investment is initial investment plus residual value. Residual value is the value we can generate by selling our assets at a closure of a business, right? Plus 2. So that is, so today okay. Today we will be discussing the other 2 items. You need to give me 1 minute. They have not uploaded the last week one. So today we will be discussing this one, the time value of money, right? What do you mean by time value of money? That is rupee today, the value of rupee today and rupee after 1 year or 2 years. Just think, last year what we used to buy with 100 rupees, can we buy the same amount with 100 rupees today, right? So with the time, value of money comes down, but only the face value remains the same, right? With time, money, so value comes down. So if someone says, okay, you have option to get 100 rupees today or 100 rupees after a year, then that after a year 100 rupees will not worth actually 100 rupees. So it has to be more than 100 rupees. If both to be equal, future value has to be more than today's value, right? That means today you invest we say as example 100 rupees after a year, which is this is year 0, this is year 1. This 100 plus some amount we should receive if the both to be same, right? Think about 100 rupees FD. So you have 100, right? Then you have right? 100, then you have 100 into your interest, right? So you can take out both of these, which is 100, 1 plus I. That will be the year 1 value. Year 0 value is this, right? That means you will get 100 rupees if I equals 10%, you will get 100 plus 10 rupees, which is 110 rupees at the year 2. This would be 110, right? We call this one future value, this one present value, right? That means what is the value we will get today, bringing here future value converted to today's value, which is the present value. If I have 100 rupees today, I can do some amount of money, work. If I don't have that 100 rupees and I'm getting it after a year, if I get 100 rupees, today it may be only 80 rupees worth or 90 rupees worth, right? If I'm not getting this 100 rupees today, and if I am to get that amount after a year, it has to be the original value this and a portion of it to compensate for inflation, interest rates, all those things. We need to have something more. Always future value has to be more, because what you did last year with 1,000 rupees, you can't do it today because inflation goes up, so prices goes up, so the purchasing power comes down. So in order to match the same, you need to get more than what you invested today, what you were supposed to get today after a year, right? So you invest 100 rupees. After a year, if you get 110 rupees, I equals 10, you can, both will be the same, right? So this is called time value of money, right? So if we write it like this, future value equals present value 1 plus I. This is your formula, right? So we say we have, sorry, so this is the only formula we have for all these future value business, right? So we have a project, or we just think of a investment, right? So we have present value today. After a year, you get Y0, Y1, Y2, Y3, like that. This is yn. So here, future value, first one, future value 1, future value 2, future value 3, future value n, right? This is the formula. First formula, it is the same. Second formula, it would be, what would be the present value? it would be present value 1 plus I, then present value 1 plus I into I. Is that clear? Is that formula clear to you? Future value 2. That means this is your first formula. You have present value. F2 is present value into 1 plus I. Then for year 1, you reinvest that and you will get year 2 future value. You are investing what you are getting. If V1, you are reinvesting and you will get something. So F2 will be this one, F1, this is VF1, right? Again, this is the investment, FV1 into interest, right? Is the formula clear or you want me to recap it? Are you with me? Can someone tell me?
So if you can just tell me about the example.
Yeah, the example is, say we take present value 1000 rupees, right? Today you are investing 1000 rupees at a rate of 10% FD, right? Future value would be 1000 plus 10%, which is 100, 1100. Is that clear?
Yes.
Right. So at the end of the year 1, you will reinvest the 1100, right? So that will become, wait, right? This is your initial investment, 1000 rupees, right? Our interest rate is 10%. Okay. Year one, you will get 1000 rupees plus 10% of that 1000 rupees, which is equal to 1000, 1 plus 10%, which is equal to 1100. 1000 plus 100, 1100. Is that clear?
Yes.
Right. So this is year one, you will get this amount. Now you are reinvesting that amount, right? Year two, your investment is 1100, right? Then at the end of the year two, right? Now we are talking about year two. You have invested this one, right? That is your investment. Then you have invested at 10%. So 10% of 1100. Okay. Then we take 1100 out, is 1 plus I, right, which is 10%. This equals 1100 plus 1, 10% is 110. So end of the period you will get 1,100,210. That is clear?
Yes, sir.
That now it is second one. Then you go to the second year. So you invest this amount. Your investment would be 1,210 plus 10% of 1,210, right? 1,210, 1 plus I, which is 10% again. We assume that the rate is the same. So you have 1,210 plus 121. So it is 103 1, right? So that will be your year 3 outcome. Just think about a FD which they have invested, and with interest it renew for another period. So your initial investment is 1,000 rupees. At the end of the period, 1,000 plus 100, 1,100. You reinvest 1,100 at 10% rate. At the end of the second year, you will get 1,210. Right? Like that, it starts going on. That's clear? Money accumulation?
Yes, sir. Now it's clear. Thank you.
Right. So that is the future value. Right? So we want in investment appraisals, what we do, we will project the future cash flows, right? For the next 5 years, what we will get, right? Investment happens today. Year 0 investment happens, but profits or the cash flows comes at first year, second year, third year, like that, right? So what you want to see, what is the value of those future profits to today's value. If I am getting 1,050 after 1 year by investing 1,000 today, is that 1,050 the same value today, right? In order to do that, what we do, we develop the formula future value equals present value in investment value 1 plus I, right? This is the formula we develop now. Okay. So what in the business, what we want to know is there is an investment here. Every year you will get some profits, cash flows. You want to bring everything here. We have to find what are the present values of all future cash flows. So present value equals future value into 1 plus I, right? This is called discounting factor. Present value is today's value. Future value is the value we will get in the future. This is 1 upon 1 plus I, which That is called the discounting factor, right? So since you have several of these things, we can write like this. Present value equals future value. First one is 1 plus I. The second value, future value 2 divided by 1 plus I to the power 2. Future value 3 equals 1 plus I to the power 3. Like that you can write. So present value, sorry, future value in year equals 1 plus I to the power n, right? So first one, it is 1, 2, 3, like that. It goes to nth year like this. So when we want to get everything together, like year 1, we bring it here. Year 2, you bring it here. Year 3, you bring it like that. You bring everything. So that is called present value, total present value equals sigma future value in 1 plus I to the power n, right? See, n equals 1 to capital N. When n is 1, you get this formula. N is 1. So future value 1. 1 plus I to the power 1. Right? Future value 2. This one. N is this one. Third year 3. N is 3. Like that. So this is your future value formula. Right? That it is nothing but 1 plus I to the power n. Is this formula clear? We didn't do anything. We developed one formula. Every year we will get profit, cash flows. So what we want to do is bring all those cash flows to year 0. Do you want re-explanation on this? Sanjeev, are you clear? Sanjeev? Okay. Right. So we will be using this formula in the rest of 2 items. Okay. That means our formula would be present value equals sigma simple n equals 1 to capital N future value n divided by 1 plus I to the power n, right? It is the same as future value 1 divided by 1 plus I to the power n into future value n. This is called discounting factor, right? What we do with this formula is you have a project where you have an initial investment I, then you will have cash flow 1, R1, future value 1, you have second one, future value 2, you have third one, future value 3, future value 4, like that you will have. Okay. What we want to know, you bring all the future values to today's value. We have to find out what is the present value of expected future cash flows. You use this formula and bring everything to the front, y0, right? That is our first task. Let's go to the right. What is the difference between 1 rupee now and 1 rupee in a year's time is time value of money. Factors change the value is interest cost, inflation, other is to materialize the money, like that is the credit risk. So future value equals present value 1 plus I to the power n. 1 divided by 1 plus I to the power n is discounting factor. This one, 1 divided by 1 plus I to the power n. Right? This example, like it is 100 into this, it's 110. This is, right? Okay. Discounting factor 0.909 equals 1 divided by 10%, right? Which is 1 divided by 1.1. That will be equal to this discounting factor. 1 plus I to the power n equals 1, right? So 1 divided by 1 plus 10%, which is 1 divided by 1.1, which is equal to this one, right? This is discounting factor. Normally, if they ask you to do a calculation, they will give you these discounting factors. Discounting factors are 1 upon 1 plus I to the power, right? First year power 1, second year power 2, third year power 3, like that it goes on. These are the discounting factors, right? So, without looking at this part, the discounted cash flows, you need to work out the cash flows year 1, year 2, year 3, and year 4. You can write it down, the 0.9. Please write it down, this one. Year 1 discounting factor is 0.909. Year 2, it is 0.826. Year 3, 0.751. Year 4, it is 0.683, right? I want you to calculate the present value of all these cash flows. This is the cash flow. First year, so let me draw this. Right? This is the cash flow. First year, 44, you will get cash 45,000. Second year, you will get 40. Okay. Third year, you will get 35K. Fourth year, you will get 50K. Year 5, year 1, year 2, year 3, and year 4, right? I want you to find out the present values of all these four, four cash flows, right? Discounting factors are 0.909. I read out the discounting factors. Don't look at your paper, just work it out and let me know, right? We will take 5 minutes to do that and give me the answer, please. So what you are doing is you have cash flows of project A. You bring all the cash flows to today's value, year 0. Present value equals sum future value divided by 1 plus I to the power n, which is equal to 1 plus I to the power n, which is the discounting factor, into future value. Sum of that is present value. So what you have to do, take 45,000 into your discounting factor. It is easy. Like this. Y1, Y2, Y3, Y4. So this is 40,000, 45, 40, 35, and 50. And what we have to do is to bring all these here. Everything here. Right? As you have correctly said, 45,000 into discounting factor 1, 40,000 into discounting factor 2, 30,000 into discounting factor 3 plus 50,000 into discounting factor 4. This is the present value, right? Present value equals sigma n equals 1 to capital N, 1 divided by 1 plus I to the power n into future value. This is the thing called discounting factor. We can write discounting factor into n into future value n. Okay. Only 3 people has answered. I want everyone to answer me. So we bring everything here. We want to find out the present value. Who are there in the class? Kulatunga Medavis, Naomi, Rosika or Rosika, I don't know. Udita, Varuni, Yashanti, what happened? Can I see the answers, everyone, please? So what you have to do here, you have the future value, multiply it with your discounting factor, which is 0.909. Second one is 826, 751, 683. Right? Just multiply and add the things. That is your future, present cash flow. What happened? No one answering? Isn't this clear? Why are you not answering? Because if you don't participate and do calculation, you will never do this. Yeah, present value 134. Right. Right. So I'm going forward. Hope you are there. Right. This is 134, 380. That is the answer. Right. Let me finish this. I'll use the board. Right. So this is the present value. Our aim is to find out net present value, which is equal to this present value minus investment. because you have to do a initial investment. In this case, it is 100,000, right? Total of this present value is 134,380. Okay, so net present value equals 134 minus 380 minus 100,000, which is 134,380, right? So NPV is greater than 0. NPV is greater than 0. That means positive, right? What does that mean? When you bring all your cash flows which are projected to today's value, it is higher than the initial investment of 100,000. If you bring all the future cash flows to today's value, Y0's value, by discounting like this, initial investment is smaller than year present value of, we bring it to year 0. Right? That means we get a positive outcome. So this is a good project. If net present value is less than 0, which is negative, then we don't take that kind of projects, because it is better to hold my 100,000 today than investing and getting money in the future, because I will not even get my 100,000. If my net present value is less than 0 or negative, means by discounting and taking all the future values to today, I will not get even my initial investment. That's why this is negative, less than 0, right? So if a project to be attractive and to be considered, always net present value has to be positive, right? When we are comparing 2-3 projects, the project which has the highest net present value, we take it as the best project. But project size has to be similar. Project lives have to be similar. If first project has a 4-year life, second project also should have a 4-year. Third one also 4-year. You can't compare a year 4 project, year 8 project and a year 10 project, 10-year projects. You have to have all the projects similar size, similar lifespan in this, right? So this is called net present value calculation. You can see this part also. Present value equals sigma n to n, 1 to n, future value into 1 plus I to the power n. That will bring everything here. Initial investment is this. So net present value equals present value minus I, sigma n equal 1 to n, future value n divided by 1 plus I to the power n minus I is net present value, right? So net present value equals sigma n equals 1 to capital N, discounting factor n into future value n, right? Discounting factor equals 1 upon 1 plus I to the power n. Right? This is the entire lecture. Net present value is what we are discussing today. So when you have A, B, C projects, lifespan has to be same, investment has to be same, and whichever has the highest net present value, we take as the best project. The investment appraisal means I have limited resources. I have several projects where I can invest this amount. I have 100,000 rupees. I'm going to invest in A, B, or C. I want to find out which one has the best return. So you bring all the revenues to today's value and deduct the initial investment, because then it is on the same year, right? Initial investment, if it is positive, we take it as good. If it is negative, we do that kind of projects. When you have several positive cases, we take the largest net present value, right? Is that clear? I need at least an answer for that. Is it clear? Net present value. Thank you, Sanjeev. Or what about others? Earlier, only 4 people answered me. Right. Then this is net present value. Then we have another thing, internal rate of return, right? So net present value, pros and cons, it takes the value of the entire values of entire lifespan. Difficult. This is difficult to calculate, right? Net present value calculation is difficult. You can't compare different projects, different lives, different size projects. You can't compare. This what we did is first one project A, we can do the same thing for project B. Then it comes 34. This is 30. So project A is better than project B, right? This is the project A1, what we did. Similarly, you can do it for project B. Then that is 34. This is 30. So whichever has the highest NPV, we take as good, right? Advantages is consider time value of money. Today rupee and tomorrow rupee, we consider that. Cash flows over the entire project life is considered. So we are not limiting ourselves like payback period. We take the entire period's cash flow. Take account of risk. That means we are considering the time value. So we know the risk. With time, risk increases. Disadvantages, it is difficult to calculate and it will not give correct decision when the project lives are unequal. 8, 10, 5 you can't compare, it has to be 5, 5, 5, 3 projects. Then we go to IRR calculation. Oh God, this has gone haywire. Right. It is like this. Right? Net present value and interest. NPV. if we draw a graph on this, y-axis, this is I, this is NPV. This point is called IRR. And IRR, internal rate of return. Internal rate of return is the rate at which NPV equals 0. IRR means it is the rate at which, discounting rate at which NPV is 0. This is NPV axis, this is 0, 0. We want to find out this interest rate, which is called the IRR. Right? IRR is the interest rate at which, or discount rate at which NPV equals 0. Right? This is the diagram. You have NPV, you have interest rate or the discounting rate, and you have a 0 NPV rate. So this is your 0 for NPV. So we are going to find out this one. In order to find out this, you need to calculate NPV minimum 2 or 3 types. I need the NPV positive but near 0. I need the interest rate I1 where NPV is positive near 0. Then we call it positive value. Then I need another interest rate where NPV is less than 0 but near 0, negative but near 0. That is called negative value. Right? I have to calculate 2 things: interest rates. First interest rate, NPV should be positive but near 0. Second one, NPV should be negative but near 0. I need these 2 interest rates and these 2 NPV values, positive value and negative value. So IRR would be IRR. It is NPV. I want 2 interest rates. I1 NPV 1. I2 NPV 2. This is called positive value. This is called negative value. Right? I have to find out these 2 rates in order to find out this IRR. IRR equals I1 plus I2 minus I1 divided by present value plus absolute term of negative value into positive value. This is the formula for IRR. Right? What does this mean? Internal rate of return is the rate at which, internal rate of return is the rate at which net present value equals 0. Right? This is the diagram for that. You have net present value, you have interest rate to the discounting rate. You have to find out this is the movement of NPV with the I. Right? I changes, NPV changes. So we need to find out the interest rate, discounting rate at which NPV is 0. This line represents NPV 0. So we want to find out this I. In order to find out that I have to find two I's. That is, one I where the interest rate at which NPV is positive but near 0. Right? It has to be that. We don't take this. Then second one, NPV is negative but near 0. This is called negative value. So IRR is equal to interest rate where NPV is positive but near 0. Then I2, interest rate where NPV is negative but near 0, minus I1 divided by positive value, negative value. Absolute term of negative value means if this negative value comes as 3,700, absolute term means we take 3,700 ignoring this thing, sign. Whether it is negative or positive, we take it as positive. Right? This is 5,000, we say. Then it is 5,000. Absolute terms means we ignore the negative mark. Right? So this is how we calculate IRR, which when we are comparing several projects, whichever gives the highest IRR, we take. Right? IRR is the rate at which NPV is equal to 0. So you can use Excel to calculate IRR. It is very easy. If you don't use this one, we used to do several trial and error methods to find out IRR. Since we have this formula, you can find out IRR by using that formula. So we say we use a discounting rate of 20%. This is a ballpark figure. You use a discount rate, this one, 20. Then you will get a positive. Right? Right? That means we have received this one. Then you need to have a higher interest rate to get the negative figure. So you put 25 and see whether you will get a negative one. If you get a negative one, you are lucky. If you don't get a negative one, you will have to put another rate, 30. Till you get the negative one, you have to go on doing it. Right? We say you put 20, then you get a negative position. That means you have reached this point. So you have to come down. Then you have to put 50 to get the positive one. Right? Remember this graph. If you get a positive IRR, you increase your rate to get the negative. Right? If you get a negative IRR, negative NPV, you reduce your rate to get the positive IRR. These are the two rates. Is it clear? Now can we go to do a sum? Is it clear? If not, I will explain again. Please let me know your thoughts. Otherwise, I am just shouting to the camera. Okay, Shanti, give me 1 minute. I'll look at others also, but I will explain again. Right? IRR, internal rate of return, is the rate at which NPV equals 0. Right? IRR is the rate at which NP right. IRR is the rate at which NPV is equal to 0. That is clear? Are you with me? Hurry up. Give me answers fast. I have few people who wanted to explain. So you need to answer me fast. Is this clear? IRR is the rate at which NPV equal to 0. Right? That means on a graphical form, this is the interest rate. This is net present value. This is the diagram. And we want to find out this interest rate. Right? Where? This point here, NPV equals 0. This line represents 0 NPV. Right? So our aim is to find out this rate. In order to find out that, I need two interest rates. Right? We call this one I1, where I1 is the rate at which NPV is positive but near 0. I2 would be the interest rate at which NPV is negative but near 0. Negative value. Right? I want to find out these two interest rates and these two NPV values as well. Negative value. Right? I want I1, PV, I2 and PV to find out I plus, I star. I star equals I1 plus I2 minus I1 divided by positive value, this value, plus absolute term of negative value into positive value. This is your formula to find out this, which is called IRR, internal rate of return. In order to find out internal rate of return, you need to use net present value equals sigma n future value minus investment. This formula minimum of 2 times or more, right? What you do, you assume an interest rate. I1, you assume. We say, we think that 20%. This is a only assumption. No one will know. It's just assume. Assume and calculate the NPV, right? We say this is the project where you have 45K, then you have 40K, 35K, and 50K. This is the project. So, and your initial investment is 100,000. Okay. 45 into 1 upon 20%, which is the discounting rate. 40 into 1 upon 20% into 2. 35,000 divided by 1 upon 20%, because I don't have the discounting rate, that's why I'm writing. 50, 1 upon 20% into 4 minus I. This is the NPV 1, which is equal to positive or negative, whatever the figure it comes. If when we insert 20, if you get a positive value, that means you have reached this point. You have achieved this point. Now you want to achieve a negative value. That means interest rate you use has to be increased. Now you use 30. If NPV is greater than 0, positive, right? If when you use 20, NPV is less than 0, that means you have reached this point. Then you have to use a less than 20, 15%, right? So we'll take the first case. When you use 20, you got this one. So I1 is 20. NPV we say and value is 3,000. We say that's 3,000. You use 30%. If NPV negative, 1,000 negative, you can take that as the negative value. If NPV comes positive 500, you have to redo it again, because your aim is to find out a negative value for NPV. So again, you have to use another interest rate. Right? If you are lucky, by 2 attempts you will get everything. If not, you have to increase. Similarly here, if you get a negative, you put a reduced value. If you get a positive, you will have an increased value. So sum up, internal rate of return is the discounting rate or interest rate at which NPV is 0, this interest rate, right? NPV, rate of interest, where it 2 lines cuts, is the IRR. In order to find out IRR, you have to use this formula, which is equal to I1, rate at which NPV is positive but near 0. I2 is, that means this interest rate, and this NPV, present value, not positive value. Then you need to find out I2. I2 is the rate at which NPV is negative but near zero. See, it is negative but near zero. I2 and negative value. Absolute term of negative value means if it is 1000 minus 1000, we take just 1000. Minus mark we remove into positive value, that is 3000. So when we calculate that, for several projects, we consider the project with largest IRR as the best project to be used. Right? Is it clear now? Dilanja, Melvis, then Deshanti, Dilanja, what is the question? Okay, right? So it comes to the end of our discussion on investment appraisals. So this has gone everywhere. You have to get it right as I wrote on the board. I'll give you 1 minute to look at the board and write it down if you have not written it properly. This is the equation. This equation you have to write it down. And this graph. It is not there on your handout. Right. Okay, let's go first. Project 1, 29,000. Then you use 20. You have to use a higher rate because it was positive. Then you get 25. You use 29,030 minus 8,000. Then you will get IRR 25. Similarly, for project B, you put 20, you get 3,100. So you put 25, you get minus 7,000. Then IRR is 22. Project which has the highest IRR is the best project. So project A would be the best. Right, difficult to use, difficult to calculate, different size projects you can't use the same method. This method can't be used for different life cycle projects. Time value of money considered, cash flows over the entire project is considered. That is the advantage. If you look at all the projects methods we did, payback period came up with A, which has the highest shortest period of recovery. ARR both were same, so we can't use. That is the drawback of ARR. NPV, which has the highest NPV. IRR, which has the highest IRR. So A is the best out of the two projects, right? Then that is the investment numerical appraisal. Like then we have to look at the project on these angles as well, right? Market or industry risk, we already discussed about that. There are few other risks like reputation. By doing this kind of a project, will we destroy the reputation? Then the operation risk is something to do with operationalization of the project. Like we have a project where it drags for a long time, then we will have operational issues, right? Then legal risk is due to any changes in the legal environment, will there be any risk on the survival of the project? Like that, we have other risks than the market, technical, financial, environmental risk. Those things also need to be looked at. Yeah, that's it on investment appraisal. Oh God. Then there was another handout. I lost the handout, so I am going to explain it towards this, right? That is 6 C's of credit. We have 6 C's of credit. So 5 C's and one more, that the cash flow. First 6 C's of credit, right? First one is character, right? What do you mean by character? That is the financial character and the customer's character as well. Financial character of the customer. That is the willingness to pay. If a good customer with good character, he will pay somehow. So in order to find out the character of a customer, we use CRIB, right? I think everyone knows what is CRIB. That is the Credit Information Bureau of Sri Lanka, where any loan goes and register there. So when the customer repay or not repay, monthly basis, we register his repayment on the CRIB. So we can check a CRIB, and if the CRIB is green, that means customer is paying promptly. If it is in arrears at the end of the month, 1 day, 3 day, 2 day, 4 day, 30, 40, like that, it is yellow on the CRIB. Then when it crosses 90, when the customer goes to NPL, it starts recording as red. So CRIBs inform us about the repayment of a customer. Then it will further gives you check returns. Check returns indicate financial discipline, cash flow issues, right? So character of a customer represent the customer's willingness to pay mainly. Then customers comes and give fraudulent accounts to us, tax evasion. That also reflects the character. That means they can do bad things if they want to, right? Then different accounts is he shows us. He brings us the account set, and when we say no, this is wrong. Also, sorry, this is the correct one. Like that, if he is doing different things, if they are not transparent, if they are not straightforward, you have to be worried about a customer, because character indicates the willingness to pay, right? Second one is capacity, ability to pay, right? Capacity will be calculated by debt DSCR, debt service cover ratio, which is equal to PBID, if tax is there, tax, divided by capital, term loan, interest, term loan and short term, plus lease rentals. This is the equation for debt service cover. If we are going for long-term loan, we consider this one. If we are thinking about a short-term facility, we calculate interest cover, which is equal to again PBID minus tax divided by interest, term loan, short-term loan plus lease interest, right? That is the interest cover ratio. For short terms, we use STL, we use interest cover, term loans and leases, we use debt service cover. That is the ability to pay, right? Then you have third one, you have capital, right? That is fixed assets, current liabilities, total assets, share capital, reserves, net worth, term loan leases, total capital. Here capital is this one. This is called equity capital. This is called debt capital. So here we are looking at the customer's contribution towards the financial contribution towards the business. This is important for two things. Firstly, it is for their commitment. If someone puts more of his money, his commitment towards that business is high, right? Second one is this. No business goes like this. It fluctuates, right? It fluctuates. If your capital is low, when your capital is small, your debt capital will be large. When debt capital is large, your monthly commitment would be large, right? When you have a larger monthly commitment, in case of a drop in business, you will have issues of repaying. So in order to avoid that, we need to have a moderate repayment, moderate financial commitment. In order to have a moderate financial commitment, your capital, the owner's funds has to be more in the business. So at least 50, 50 or debt 60, 40 should be there. Minimum of 40% of equity capital should be there, right? Character I explained to you, trip or wrongdoing, non-transparency, those things, that shows you the willingness to pay of a customer. Then capacity, it is the ability to pay, the ability to pay long-term borrowings, which is calculated by debt service cover, short-term borrowings, interest cover. Then capital, which is the money invested by the customer, that is the equity capital. When equity capital is high, debt capital would be lower. We need this for two reasons. Commitment, when someone invests their money more, their commitment towards the business would be higher. And the ability to service. Indirectly, this one assists this one, because business fluctuate in their operation. So if your commitment, financial commitment is high, in a downward trend, you will have issues. If your financial commitment is moderate, still you can survive, right? That is the third C. Fourth C is, fourth one, it is condition. Conditions, in the sense, those are not the conditions we put to a customer when granting a facility. This is the environmental condition, the macroeconomic condition of the business. Like if it is a tourism hotel, it is the macroeconomy around the tourism sector, whether this customer is in a good sector. What will happen if the sector position changes? Condition is the macroeconomic condition where this customer's business is in. It is not the condition bank puts in giving a facility. You need to keep post-dated checks, you need to send us current account operation, you need to bill cash, not those things. This is the condition where this business is in. If it is a hotel, tourism sector. If it is an import, then trade sector, like that, right? That is the fourth one. Fifth one is collateral or security. If everything goes bad, we should have a second way out. That is the collateral or security. This is 5 C's of credit. If you add cash flows, right? Cash flow, that is whether the customer will have enough cash to repay. These things are calculations only. Capacity, debt service cover, we are not bothered about the actual cash. We P&L basis, because P&L is prepared on accrual basis. When you are preparing a cash P&L, you are not bothered about whether you receive cash or not. When a sales done, you recognize as a sale, right? So it is called accrual basis. Cash flow means actual cash in and cash out. So whatever remaining you need to use for the settlement. So whether you have generated enough cash to service your debt, that is called cash flow. So these are the 6 C's of credit. This is the basic principle in credit. Character, capacity, capital, condition, collateral, and cash flow. If the examiner asks you 5 C's of credit, you stop here. If there are 6 C's of credit, you go there. Right? This is the 6th. Right? So character is the willingness to pay. Capacity is the ability to pay. Capital is the commitment and ability to pay. Condition is the general environmental condition where the business is in, or the macroeconomic condition of the industry this subject business is in. Collateral is the second way out. If everything goes bad, how can I recover my money? Do I have any fallback option? That is collateral or security. Primary mortgage or property, vehicle, that kind of thing. Cash flow, it is the actual cash in and cash out. That is the availability of cash to service my debt. Right? That is called cash flows. So 1 to 5 is 5 C's of credit. 6th one is the 6th C of credit. Right? I lost the handout, but you have that. So please go through it. If you have a question, next time I can answer you. Or if you have any question from today's class or last week's class, because many of you were not there last week, you can ask me now. I have a few more minutes to go. If no questions, I am done for today. I prefer all of you attending the classes and discussing matters, asking questions and answering questions. Okay, Sanjeev, what is the question you have factoring? Can you kindly wait for 1 or 2 minutes? Let others also throw their questions they have. Malak, I don't think there will be a discrepancies in IRR and NPV, because IRR is calculated using NPV, right? IRR is the rate at which NPV is 0. We extrapolate NPV to find IRR. Is it clear, Malaka? Because IRR is a derivation from NPV. Malaka? Right. Sanjeev, what is your question? Sanjeev? Is it only carried out before a sale every time or not? Yeah, it is not before a sale. Like factoring, in factoring, we approve a limit, we approve customers, right? Like we say we have 25 customers, but factor will say, I will be granting you money only for A, B, C, not D and E, then F, not for G. Like that, factor, the bank or the factoring company can decide we will be giving out money only for the sales my customer has done to these customers, his customers. And I can put limits. Okay, if you sell up to 500,000 for customer A, I will pay. If you do 600,000, I'm not bothered. I'm not paying you money. I'm paying only up to 500,000. That is 600,000. It is your own risk. Don't come to me. For B, it is only 200,000. So these limits has to be in place. Then what the customer does, he goes and sells and send the invoices to factory. So factor maintains the balances and say, okay, you have sold within the limit, so I'm giving you out money, right? So it is one-time agreements. Then within that agreement, you can operate. Sanjeev, are you okay? Or you want me to explain it? Okay, right. Okay then, thank you very much for everyone. We'll meet next week.